Hey, founders, happy Friday. It's Tanya here. Oh, I am curious. Have any of you ever heard the term girl math before? I had not. I hadn't until last week when my daughter dropped it on me. And I'm not going to lie, I was mortified. So, girl math is it's satirical in nature, but the premise of girl math is justifying a woman's spending habits. So, for example, I saved $100. I saved $100 today because I bought these shoes on sale. Or this concert is basically free because I bought the tickets 8 months ago, right? Those are examples of girl math. So, again, being a financial coach, mortified with this term and turned to my daughter and I said, no way, this is not girl math in your world. Your narrative, my love, is you know what? I'm bright and I'm brilliant and I'm beautiful. And girl math for me is that I earn enough money so I can share, I can save, I can invest, and I can spend smartly on good deals with these shoes. That is my version of girl math. Don't worry, there's boy math out there too. But the premise of this video is that it got me thinking about what would founder math look like if we applied the same lens to it. And I think it would go something like this. So nothing against people out there that make dog cookies. We know each other. We have several founders that are phenomenal, fierce founders that make dog cookies. But as an example, I make dog cookies. I know that there's roughly 600 million people in North America. Let's say half of those people are dog owners. Now we have a market size of 300 million. I'm going roughly after 10% of that. That is 30 million. So now I've got 30 million people that are going to buy my $10 bag of dog cookies, and now I'm up to 300 million in my first year of sales. That might be founder math. Compounding that, founder math might be where the founder looks at the bank account balance to establish their net worth, and or maybe waiting for the accountant prepared financial statements 4 months after year end to determine whether or not they made any money in their business that year. Unfortunately, all joking aside, I think that's the reality for a lot of founders. I do happen to know that 82% of founders go bust in business because of founder math, because they don't understand their numbers. So today I want you to think about founder math differently, the same way that I did with my daughter, where let's change that narrative. I want you to think about founder math in this light. I'm calling it fierce founder math because this is the work that we do. But here's 5 factors, when not 10, 5 factors when it comes to founder math. The first thing a fierce founder does is they know exactly what they're building. So 5 questions that they know is, I am building a business that is going to be worth X. No, question number one. By when? Point number two. For what, or sorry, by having what impact? That's point number three. On whom? Point number four. By offering what products or services. So let me give that to you again. I know exactly what I'm building by. The value of my business is going to be worth X. By when? By having what impact? On whom? By providing what products and services. That's where we start. It's that end goal. The second thing a fierce founder does when it comes to founder math is they know exactly what their sales need to be, right? So it's about knowing what their sales need to be to ensure that they end up with a healthy net profit while covering all of their direct costs and indirect costs. That's point number two. They know what their sales need to be. Point number three is that they are so dialed in on their direct costs, so they know exactly what they are going to be out of pocket, materials, inputs, subcontractors, direct labor per product or service. The fourth point is that they know what their indirect costs are, and the indirect costs are what we call operating expenses. They're fixed expenses. They come due regardless of whether or not anything is sold. And a fierce founder accounts for a fair market salary for themselves. That's what the fierce founder does, right? Okay, where am I? Point number 5 is that they are so dialed in on their net profit. It's actually where they start their planning process, but they know they want to end up with a net profit at the end of the year. So they plan accordingly. Now they know what their sales need to be, but they know with that net profit, they know that X% is going to go to income tax. X% is going to go and feed their emergency fund, AKA retained earnings on their balance sheet. And X% is going to go back into the community, right, for philanthropic efforts, for giving, for social impact. It goes back. So that is the bottom line. That is founder math. Fierce founder math is when we know exactly what it is that we're building. We know exactly what our sales need to be to cover our direct costs, our indirect costs, and to get left with a healthy net profit so that we can pay our taxes, establish an emergency fund, and give back to the community. When we apply this lens to our math, this is what helps us not only survive as a founder, but helps us thrive as a founder. And our economic ecosystem becomes stronger. All right, that's it. This is Tanya signing off, reminding you you've got to know your numbers if you're going to nail them. And if you want more intel and insight like this, every Friday I come here. So hit like, please, and subscribe. And we'll see you next week. Bye for now.